Hello, Warriors. Yes, Brand, it's not that easy, is it? So you're just trading. Running a business and trading is a little tough. How you doing today, AJ? Who else is here? Sinatra's in the house, and Laura, good morning. Okay, so I want to start off with the S&P. Hello, Michael Bergman. Good morning, good afternoon, team. Hope everyone's doing okay.
Hello, Dale. Good early morning.
I hear you're famous. I saw it on Skype. You're famous.
Really?
Gonna tell your mom.
Well, shame. She's not with us anymore, but she would have been proud of me being such a popular person on Discord.
She's still proud of you.
Oh, she would. She is.
Wherever she is. So, the S&Ps, if they're going to be proud and stand up strong, they better dig in their heels right here. Dollar up pretty good. So are we going to break down in the S&Ps during this last push in Euro, maybe down to, what we've been looking for months? One thing I have to say is even if the pound does get down to this, take out this low, there's nothing impulsive about what's happening here. Sometimes I get fooled when you have these quiet tops or bottoms and they just like erode and then break down and turn into something. I just think about how much risk off we've had, how the metals got creamed, and how FX is giving it up grudgingly. Okay, really not on risk off days, not giving up that much today. Yeah, but it makes me think that when this thing ends, there might even be another run in the dollar to new highs.
The main reason for that is that on the limited moves, let's put it that way, on the
especially cable.
Yeah, because all yields are moving together.
Okay.
Dollar is the biggest market, but it's not standing out versus the rest. Most of the yields are moving in tandem, and we've seen the CPIs are moving together a bit in the major land as well. So that's why the moves in FX seem a bit subdued. This being said, the dollar is still, I think, a wanted animal on dips.
Okay. Precious metals giving a little back. I was thinking about this as could be a setup that perhaps gold doesn't make a new low, maybe pulls back to 1815, and maybe silver does. Weaker RSI structure, never got to the fib at 2020. We'll see. Or I guess, if you're bullish and you feel you missed the bottom, not a bad place to try it with stops under the low, but I'm going to try and be patient, see if that sets up. That'd be a pretty good signal with silver making new lows and gold making a higher low. I think that's a possibility. Great call on yields for Stelios. Still looks like they're blowing off. I don't know where the highs are going to be here. I know that 5%, 495 is a longer term target that I saw from Goodburn's work, and definitely I was wrong thinking that we might get a pullback in yields. We're smoking.
I think morning, Dale.
So
I think that we're gonna keep grinding higher. I know I've been saying this for days and weeks. 433 is the next level. And after that, if it does get broken, I think we're going to see one final capitulation move higher in yields, somewhere between, 450 and 5%. And I think that's going to be it. But for now, I think a grind higher and we just keep going.
Yeah.
And
that's
you see the same. Sorry to interrupt. Oh, you see this everywhere. We saw Eurozone CPI coming in hotter than expected. US CPI is not dropping. I thought it would be already dropping. It's not dropping. So the central banks really have no excuse not to keep going. That's my. I take a few steps back and I look at the big picture. That's still the big picture. It's going to change, but it's not there yet. So yeah.
Okay. Yeah. Definitely. I wouldn't short it here. I don't see any reason to do it. I think we might still be diverging a little bit. If we close good today, we'll probably blow out the divergence because I think we're approaching 75. And that's a nice looking candle. Again, they tried to take it down and it was a beach ball and just headed right back up there. So yields are the name of the game. Let's get to some FX action. I'm going to try the yen again at new highs. Okay, I maybe we top here, but it wasn't a bad short here the first time when our whole community did it, and the team got short up here near 37. It's going to be an even better short, which the conflict is that yields still look pretty good. But I think it's going to be an even better short because this time the RSI is going to be a lot lower than 70 because we're only about 30-40 pips away from new highs here. View, Ryan?
How sweet is your MA there? Your 200?
Yeah, look at that. 200? It's better than the trend line.
Yeah.
And that's a 4-hour TF, bro.
Yeah.
So
but, no, I get your point. I'm tempted to have a last fling at this 137. No, I think I'm probably going to be in the wrong. And if we break 137, I'm folding out all my core short positions. Going back to the drawing board.
And I'm going to be on the other side of that. I'm just going to take it all in, Ryan. Yeah, give it to me. Give it to me.
Johnny, I'll give it to you cheap. I'll give you a discount.
So
good morning, guys.
hey, Blake.
Hey.
So yen, we'll see what happens. Any major news releases today or tomorrow for the rest of the week?
ISM tomorrow.
Okay.
I think there might be some other bits and bobs, but yeah, ISM tomorrow. Not a lot today, just jobless claims.
Okay.
If it's yen related, we have Tokyo CPI tonight and the Japanese employment rate, services PMI coming up as well. Looks like the market wants to go and test those 100, 200 DMAs after all. Perhaps quick look above 137, but not sure.
Yeah.
There's much more juice in it before the next Bank of Japan meeting.
Okay, when you were out, I wanted to ask you, K-Man, that really your wheelhouse is FX, but I've noticed over the last matter of months that you want to build long positions in silver. And I'm wondering what your narrative is that makes you like silver, that you want to be an accumulator at opportune times.
It's a couple of reasons. I think that as we've seen, the pure economic data are not really falling out of bed.
Okay.
If ever we find that China is reopening, but there are a few geopolitical problems, it should be good for industrial metals, perhaps,
like copper.
Sooner or later, the hiking cycle for the interest rates is going to be over. So I think industrial metals should at some point find the bottom, and I think also that. But the reason why I'm very cautious and going in very slow is that we are not at the end of the hiking cycle, and we still have geopolitical issues. So that's why I'm just very cautious. But I've started very, very, very shyly to do it.
Okay.
And actually, I'm in silver, but I may start to look at stuff like perhaps copper But for
Yeah,
the long term, if we get
Yeah.
another shakeout, I'm just trying to
take a look at, if you like the metals, take a look at platinum. Has a much better structure than anything else. And you're old enough to remember platinum trading over a premium on gold.
Yeah,
And right now we're at, $900 discount. So, I mean, even if I think the spread will work,
Yeah,
long platinum, short gold. I just wanted to share one miner with people. I know we don't talk too much about stocks, but you guys know that I trade the miners, I position in the miners. This is one that this is the best action I've seen in BTG. I was waiting for 78.6 at 310 and I didn't get it. And actually this day was the day before gold bottom. So I'm thinking any pullback towards 335 would be a decent buy. And I'd even add some at 78.6 if it still got there, and wrong under the low under 260. Because if this is going to be a wave 3, it could be a pretty big wave. And when you look at a longer term chart, like a monthly, I believe that this leg that we had here, this is a pullback and that we're going to run again. So, there's plenty of upside if we're going to have a bull market in gold. In 2020, it was 750. So I just wanted to share that one's looking pretty good to me. And I'm hoping for the setup that I talked about. Silver makes a new low, gold makes a higher low. So it could be sometime next week. Just wanted to share that one with you guys. And Ryan, the EG keeps, it looks great. When I look at it on a monthly, it's like, big move. All of this has been consolidation. You have targets to the upside. I know Stel was talking in the 90s, which we got there for 20 seconds.
Yeah.
That was the gilt debacle. Think we're headed all the way back up to these levels?
I think if we can break 90, we are.
Okay.
I don't know what it's going to take to break 90. Maybe the ECB, really ramping up the hawkishness, sort of following the Fed. I think we're potentially heading that way. The market coming around to 50s for May now, not just a 50 or a last 50 at this next meeting.
Okay.
If we get up there, I'll be looking at shorts, definitely.
Okay, maybe it's not going to be, maybe it's a combination of hawkishness of ECB and maybe, some economic problems in the UK or political problems. And because EG did what it did, Blake brought it up yesterday when Euro was up 90 and the pound was barely higher, that made the pound vulnerable, which is exactly what happened after you said that. Okay, so maybe that's what takes it down, because a lot of people have been, pound has had a better look. You've gotten better upside when you bought it than you did in euro. Still could be some people stuck long cable here.
Yeah, you're right, but it's also the the central bank divergence in play. Supposedly the Bank of England are close to pausing while the ECB is still hiking and the Fed might go even higher. So on that front, it's clear as day why the pound is softer. Really looking pretty much across the board. It's that same old central bank divergence.
Okay.
Doesn't it look like, I mean, and by the way, Dale, I happen to just in the ForexAnalytix community shorted the cable for like 50 pips. I haven't stuck around for a long period of time in the cable because we're so close to this 200-day moving average. If you don't mind, I'll take over the charts here. Yeah, we're so close to the 200-day moving average that it's really, being short here doesn't, from a risk reward perspective, doesn't really make sense. But you start getting below that 200-day moving average on a closing basis, and then the risk reward shifts, because then you got momentum behind you. You can put your stops right above, yesterday's lows or this, last week's lows. and get a fresh momentum move on a big double top that's developing here. But it is really trading like crap. It's traded like crap for weeks. I mean, I have a hard time wrapping my head around trying to be long sterling when it's, other than understanding it's near support. But one of the things that we talked about last night on the trade-off, with Chris Weston, was just that even that Brexit headline, Ryan, I mean, and they just slammed the sterling right after that. That in itself tells you that the market just doesn't think that that's going to be very good for the UK, right?
No, it's, as I've been saying, the market is completely ignoring it.
Or the market thinks it's not going to happen, or it's bored of all this stuff. Maybe.
Well,
yeah,
I mean,
it moved. Cable moved 4 pips or 5 pips when the headline dropped. The market isn't trading it. There may be some who are, doing a bit of positioning around it, but this stuff has been going on for months. We got a deal. The proof is in the pudding. Who knows when the sausages start coming back? No one's trading sausages in the next sausage outlook for the next 6 to 12 months.
Well, at least we don't have to learn how the sausage gets made over there. Oh, actually, we do. As Americans, we get to peer in your parliament sometimes, and boy, that's the way the sausage is made there. With UK politics is something that is to behold. That's for sure.
Something made there. It's not sausages. I'll give you that. It begins with S though.
Anyway, hey, so we're just get you guys' view here as we go into this Thursday. I wanted to ask, I don't know if you guys talked about it. Dale, did you ask him about that? We had Eurozone CPI come in last night, and it came in pretty hot, right?
Yeah, Stel was talking about it.
Yeah, that didn't help the euro at all. I mean, we got the euro like cracking through some support. You could argue, I always use the old analogy like horseshoes and hand grenades. I mean, the euro inverted head and shoulder pattern pretty much completed within, maybe 10 or 15 pips there, but you can see a pretty big pivot of the euro, and I can delete all this stuff now. I mean, we're about ready to trade a 105 handle, on strong Eurozone CPI data. Why is it moving lower? What do you guys think here?
It just wasn't finished correctly.
You guys are coming in and buying up dollars.
And how about this?
New high?
Yields new high. Yeah, we got bonds absolutely under pressure right now. Yields continue to rip higher. Look, the data that we've gotten here in the US has been nothing but staggering. I mean, you go back to last month's jobs report, just start there, and then take all of February's data in the US for the most part. I mean,
not all of it. There were a couple of PMIs.
Yeah, there's a couple, but for the most part, hot prints all across the board. Yields are going up, expectations are going up. Look at the 10-year. This is 10-year yields. Look at the bond market. Here's the 10-year. Here's the 30-year. Here's the have you seen boons? Boons are absolutely just crapping and hitting new lows of 2023. I mean, you got yields ripping, globally, and it's no wonder that you got the dollar that's, looking like, hey, that terminal rate from the Fed is going to have to go higher. And, it's even taken the dollar yen up with it, and I'm short dollar yen, I'm long dollars against other places. But this dollar yen, as Ryan was just saying, looks like we're going to get above 137. I think that's entirely possible because it wants to stop out as many people as it can. But you're seeing the dollar just really move. And, so what's to say that the euro won't revisit 105 or maybe even lower? And then what happens? And, this is like another thing too. You got the cable. What is going to get the cable? And I know you can say it's, pound related maybe, or UK related. But if you think about like this double top extension and where it could go, like the opportunities, if we really start breaking through 119, 118.50, because this would be, as you can see here, let me grab my pen. This is you know, this is 119, right? This is 118.50. And this takes us to 113, would be a full, you know, range extension of this move right here. So if we get down to 113, that's not going to be all UK related. I mean, there's no way. I mean, unless there's like, you know, I guess it could be theoretically, but it's going to need some help. So the only way that that's going to happen is to get some dollar strength happening elsewhere, where, you know, you get the euro that might, you know, see maybe 102 or 103 again, you know, somewhere down here. Do you guys think that that's even possible right now? Are you guys even thinking that? What are your thoughts, Stelios?
Sorry, I was actually doing something with
no
the
problem.
client.
What's your thoughts?
What's the question?
Don't worry about it. What do you think, Ryan?
No, I don't. And I think to your point, you know, if you have a look at when US 10-year yields were coming up and we were banging ahead on the 395, 398, those were fresh highs at the time, you know, going back to the beginning of this week, late last week. That's when euro dollar hit the lows, 105.30s, because it was all about what was happening in the US. Now we're hitting over 4% and we're still 70, 80 pips off that prior low in euro dollar. So it tells you that, you know, this yield story, as Kay said at the beginning, it switched from just being all about the US to now all about everyone else. Yields are going higher across the globe. So you're going to get currencies moving at different speeds. If it's all about the dollar gains against all other pairs. When it's all about the US and the ECB and the BOE and whoever, then those currencies aren't going to fight against the dollar as much as they were before. And that's what I think you're seeing in the euro dollar. Can it get down to 105? Of course it can. Does it need your scenario of an even more stronger dollar? Yeah, it needs that. But on its own, just on the yield moves, you know, the ECB could be going to 5% rates.
Well,
you know,
let me
the Fed.
I hear what you're saying. But let me ask you this. We're pretty elevated in the equity markets, and you could argue that, and this is the argument right now. S&P is trading at, you know, 39.50. We're trading at the 38% retracement literally of this entire move. So it's 39.33 is where we're at right now of this entire, you know, bounce that we've seen since the end of last year. We're also at you know, this is the previous channel. We're back at the support. We're where the stock market is bouncing where it should, and it's getting support where it should. What if the market says, oh my God, you know, yields are way up here, and they reprice, we got to reprice, and the stock market sees 3,700 again in the S&P. Who's going to be the beneficiary there? Is that what takes the euro down or the dollar higher, and it takes the sterling down and the euro down? I mean, I personally, I would think that the biggest beneficiary is going to be the dollar at this point.
You know what's interesting? If you go back to last October when yields were peaking,
during the hunt for Red October.
Well, that's when we were at 345.
Somebody got it. Thank you, Stel.
Yeah, I got it.
So I'm sorry, bad joke.
All right,
go ahead.
It's okay.
Dale, yes, back in October when we were talking about yields. My bad.
Yeah, we were at 430, and then go look at any currency or the dollar index, and we're not that far away from 430. And the dollar index in October was, 112.
Yeah,
and euro was par or lower. So we're almost at the same rate level here. Yeah. And it's not having the same impact that it had then. And that really makes Ryan's point that the leadership of this, as the mantle's been taken away, or higher rates just do not have the same type of bang for the buck to support the dollar like it did a year ago.
And I agree with you, but what was the difference between where the S&P was in October of last year versus where it is right now, which is, by the way, in orange?
Yeah, 3,500.
The S&P was at all-time lows when yields were ripping.
Yeah.
So yields have been moving higher. Stocks haven't been stocks haven't
They've been resilient to it.
They have been resilient because people are like, oh, no landing. We're gonna just
no
coast
landing
on
now.
in.
Yeah.
Look, if the market starts to get the point I'm trying to make here, and then we can continue to talk about this, but the point I'm trying to make here is if stocks actually get the memo and they go, holy crap, what are we doing way up here? And stocks actually start to sell off and they start to break down. The biggest beneficiary, and my opinion, is going to be the dollar, and the dollar is going to play some catch up. And we will see the euro trading at 105 or 104, and we'll see the sterling down at 118, things like that. Yeah. But anyway, that's just my opinion with that.
And
Ryan, you were going to say something there?
Major move. That's
Can you quickly look at a weekly chart of the S&P?
Yeah, let me go ahead and
But by the way, Hunt for Red October, Sean Connery playing a Russian submarine captain.
I'm so sorry.
And a very, very heavy Scottish accent.
I am so sorry. I actually brought that one to the table and got Stel was talking about that. I'm so sorry, everyone. Just kidding. All right, so it is a great movie. Is it what do you want me to bring up? I'm sorry, Ryan.
Yeah, so there's the weekly, and look at that phase from September last year. Oh, is he out far enough? I can't see if
September of last year. That's right here.
Yeah. So we're if you look at it from that perspective, we're in an uptrend. It may be in the middle of a bigger downtrend from off the all-time highs.
Yeah.
But that's still a significant uptrend that we're seeing there through the latter part of 2022. So until that breaks down, that's when you need to be worried about stocks. If that trend breaks down.
God, that's a long way away. I mean, you're talking like literally by the time you start saying we're in a bear market again, we'd lost another 10%. Yeah. Dude, that's a long way. I don't know. My long-term view is unchanged. We are going to be fiddle faddling. I use this word. I used this term yesterday that some people never heard. We're going to be flip-flopping and fiddle faddling for the next probably the next 5 to 10 years of doing this. It's going to be maddening, but good for us traders, right?
Yeah,
if we do.
Good ranges.
Yeah, good ranges, good ways to trade over the next several years. Anyway, we haven't heard from K-Man much. We heard a little bit. K-Man, you have anything to say regarding all this shenanigans we're talking about today?
I think the reason why we are still here and not at levels where we were in September, October is interest rates differentials, which have been reduced between the dollar and the rest. And on the other side, trading a soft landing or no landing. And that's what I've been saying a couple of weeks back, saying like stocks could hold up better than the dollar coming bid or the yields being higher. So it's there. There may be an inflection point though. If those yields continue across the majors, I could see some trouble starting to happen for equity markets in general, not specifically US, but they're probably going to go together as well.
Okay. Well, thank you very much for your input there. Hey, really quick before we pass it back over to Dale, I know everybody was getting really hot and heavy on the whole China reopening story that happened 2 days ago. And but if you look at the US dollar CNH, it is reverse course after the initial headline. If you look at copper, just really quick, copper looks, where is my copper? I don't know why it disappeared. Oh, there it is. Look at copper here has given it up too, and the Aussie, just as near flag support, which the Aussie still has to complete its head and shoulder pattern. We still have a lot of downside here. Just heads up. The reason why I point this out more for you currency traders is because if you start to see a deterioration in risk and you start to see stocks breaking lower. By the way, if you guys haven't noticed, NASDAQ is below its 38% retracement. What I told the ForexAnalytix subscribers yesterday is when you start seeing the individual indices starting to break big supports, today is the NASDAQ, in case I didn't mention that just a second ago. then you really have to start worrying about what's going to happen with the rest of risk. If you have the NASDAQ breaking down, the S&P might follow, then the Dow might follow, then the Russell. It's like dominoes, you know, it's just like a little set of dominoes. You got the first one has just fallen already. Only thing that's keeping up the Dow right now is Salesforce.com, which, you know, if you took away Salesforce.com, the Dow would probably be down like, I don't know, 1%.
The
maybe?
Dow is actually the weakest in the last decline. It's
we
actually
just
led
got
it.
I'm sorry, we just got news. My bad. We just had weekly unemployment claims. Let me go ahead and do. I think we did. That just
They're
hit
in
the
line.
market.
You know, plus or minus 5K. Who cares?
Then what's the data that just hit?
Dollar
that,
got a little stronger.
Yeah. Well,
Unit labor cost is
unit
higher
labor
than expected,
costs.
but
Yikes.
productivity is lower than expected. So
That's
Prices
not good
matter.
either. That's inflationary.
Prices matter. They matter.
You know,
Well,
lower
33
productivity
going up
is
everywhere.
inflationary. Yeah.
People think that inflation's out. It's good. We're going into deflation. Stelios is going to be dead wrong and owe me like lots of beer.
good.
No, it's actually not good. I'd rather actually see us deflate a little bit. But problem is you're seeing prices go up everywhere, and people think central banks are finished, but they're not, and that is a problem. That's going to be a problem for equities. That's going to be a problem for sentiment. That is going to be okay. I'm going to go put my tinfoil hat on. Dale, I'm going to pass it over to you, and I want to say thanks everybody for listening in to the F.A.C.E show. But don't ever leave when we're finished with the analysis part, because Dale brings in some of the best people on the face of the planet in the finance industry to interview for a half an hour. So make sure you all stick around. Thanks, team.
Hey,
Cheers,
team,
all.
I did notice before I bring Thomas in that there was a tweet that talked about, maybe you know about this, K-Man and Ryan, the ECB, I believe it was the ECB, lost, I forgot how many billions in a bond trade. And they said that there aren't as many safety valves left. It's like, you know, almost sounded like they had margin calls or they were under duress from losses in their own portfolio. Have you ever heard of anything like that?
It has been touted that all central banks face losses on their QE. You know, they're buying bonds and
Yeah.
you know.
I think I retweeted it, but it said that they were, running out of reserves to cushion anything else that might happen. So anyway, just I found it kind of frightening. Anyway,
May I jump in here?
Yeah, go ahead.
Yeah, what is the biggest difference between the European Central Bank and basically all other central banks?
Yeah, all in the same hole.
No.
Yeah.
What is the biggest difference?
Tell us, Thomas.
Well,
What
if
is
you
the big-
think the Federal Reserve reports to the Treasury of the
Okay.
United States, to whom
Right.
and which covers its losses, who does cover the losses of the ECB? There's no
Nobody.
government, no Treasury, nothing.
Okay, so
So
they
there are
could.
just the national central banks, and behind those are the governments. So the ECB, no, there is no actual procedure how to handle their losses, and that's something people should be afraid. I think a lot more than
Okay,
they are.
all right. So then the news I saw that's valid, right, Thomas?
That's absolutely valid, and it's actually worse when you see it, because the thing is that they built. I don't remember how big was the buffer. They built a buffer on the gains they got on the bonds during the QE. They built a buffer in the national central banks, but it was something in the range of, I think, 130 to 70 billion. And
Okay.
I haven't looked at the losses of the ECB, but I think they are soon gone. The buffer is soon gone. And what then?
Okay, that's what I was wondering.
Yeah,
What
that is really an interesting question, because there is no procedure, and that no one assumed that the ECB, when they created the euro, no one assumed that the ECB would take such a heavy losses, which are not coming.
Okay. Well, what a great segue to bring in, Thomas. Welcome back
Thank
to
you.
F.A.C.E. And You did say that you were preparing a report that you wanted to share with us, so we're all girded up and ready to take anything you could throw at us.
Good, excellent.
All right, we
yeah,
have no fear. We have no fear
okay.
until
Good,
until
good,
we
good, good.
until well.
Until,
But I'll be crying.
yeah.
I'll be crying, mommy, when your narrative
okay,
becomes.
Okay, so we've been doing two things, and we have been doing two things for the whole beginning of the year, basically. So first is we have been building a global liquidity database. It's rather interesting, the information we get from there, but it's not ready, so I will not present it here. It will be saved for the next time. But that I will tell you that there is most likely there's a massive withdrawing of global market liquidity going on right now. And it's our forecast that the markets will keep falling from here, or there's a bear market from here till maybe late April, at least.
Okay.
So it begins,
right.
it may have already begun in the end of February. There's really interesting stuff in the, when you start to look at the global liquidity and the sources. China is dominating it completely now. So it's really something else. But the other thing we did,
so China dominating in what way? They were the only central bank to be easing.
No,
so are you saying
they do these kind of a even seasonal? I have actually explained it in my newsletter in the first findings we got, but they do these really strange seasonal injections and drainings of market liquidity, like the September October route which we saw. It was actually, it coincides with the draining of the Chinese liquidity and also the QTs of Fed and the ECB. And the global liquidity actually declined from September till October by over $500 billion US. That's a massive, that's a record. So it was no wonder that, you know, everything started to fall apart. But then actually the global USD global liquidity started to grow from around mid-October onwards, and one big factor there was China. But it's the global liquidity picture it's a very murky one, but it's basically what drives things now. So when people are talking about interest rates and you know earnings, that's good. But the liquidity situation is so volatile now that it drives the market. That's for certain.
You know, I talked to Harold Malgrim, who is, you know, he's pretty well connected, and you know, through all these administrations. Do you know him?
Yeah, I know.
He's worried about the shadow banking system here in the U.S.
Of course, everyone is, but I'm not actually worried just the shadow banking system in the U.S., but the banking system in general.
Okay.
So there's like the second thing we did is that we looked at the U.S. economy. So there will be this is published on Tuesday. This is a special issue on the U.S. economy. We published this Depercon outlook each month, and we concentrated on the U.S. economy here. And we have this forecast. I close that. Okay, so we have this forecast, and what it looks like that strangely, if you look at what happened past year, Eurozone grew the fastest, which was, I think, nobody's guess in early 2020, but it happened.
Because of the weather? Did the weather provide the buffer for that growth?
Yeah, it's basically here. The weather is here. If it would have been worse, like winter was very mild, this figure would have been negative.
Okay. So it's weather. Mother Nature bailed out Europe another season.
Basically, and actually China's stimulus. But just so the nowcast now look that the Eurozone will fall into recession, but the US will keep on growing for a while. But there is massive uncertainties. But the thing is that what we've been following for the past 5 years is China's stimulus. So it's basically, let me enlarge this. So,
did you before you really get into China, you know, someone sent me a picture of the Chinese demolishing their ghost cities. Is that real too?
That has been going on for years now.
Demolishing them.
Yeah. No, of course there's no official confirmation, but some cities just vanish. because they,
Okay.
there's no one going to live them, so they demolish them and build new. It's a
So
crazy.
that stimulates the economy.
Yeah, of course,
All
stimulus
right.
building, but it's a crazy Ponzi scheme.
Yeah, okay.
So,
All right.
okay, but here's the thing. This is what we have been trying to educate the general populace or the analyst and investor for, I don't know, 5 years. So this is Chinese cumulative aggregate finance into the real economy. And this is what drives everything in the global business cycle now. People think it's a US, but no, it's a China and the stimulus. And this one here is past year. And it kind of, this is flow, so that's what grows. It's flow from each month. So
Okay.
it reaches a peak in September, and then it starts to decline. And what this means, what we found already 5 years ago, that this lags the European economy about 3 to 5 months, and the global economy around 4 to 5 months. So whenever this starts to go down like this, or that it doesn't grow in a trend-wise manner, the global economy will get hurt. So the thing is that now this happened in October was relatively okay still, but then it went. November and December were really bad. So we're going to see the global economic indicators head down this month and next month, and then maybe there will be a recovery in April. This is how it's going to go. I'm just telling you.
Okay.
But this has worked for several years now as we've been looking at this, but this is something people don't really.
So are you shorting, I don't know if you do it, are you shorting US equities or European equities? Huh?
We have been out of the market for 3 years, but when we got the global liquidity database in order under the forecast, then we'll go back in. But we would be, I think we would be shorting now. I think we would have gone into shorts maybe mid-February.
Yeah. Okay. Yeah, so, because we're right on the verge of very significant support here at 3,900. Yeah. If we take that out, who knows where the bottom is.
Yeah. I think that we don't do technical analysis, but what I heard, what I read, it's saying basically the same things. Okay, but the U.S. economy first, the retail sales and recessions. This has been kind of a standard series. Everybody has been accustomed to this, but there is a. If you look at this is the collapse to the Russia-Ukrainian war, and ever since then, the retail sales have been in a kind of doldrums, but not in a recessionary territory. And the reason that has not happened while the interest rates go higher is because there has been rather massive accumulation of excessive savings during the Corona lockdown. So from the lockdowns itself, when people just couldn't spend, and then the stimulus checks. And we currently estimate that there's around maybe $1,000 per household left. And when they are gone, the US economy will simply stumble. And the reason, I said, so the yield curve shortly, is basically this. So this is the net percentage of banks tightening lending standards in the US. And as you can notice, there is the two figures here. One is for the credit card loans, which is this one. And this is the loans for commercial industrial loans to small firms. And if you look at this, you notice that we're already in both of these at the level we were in the first half of 2008, when the US economy was already in a recession. But we have to remember here that we start this tightening in an extremely low level and with high excess savings. But the thing is that when the excess savings are gone, interest rates are going to be so high that the US economy could simply just stop. Consumers could stop, just spending. And what I heard from the previous speaker, he was speaking how prices are rising everywhere. And this is what we hear also. So people think that, okay, inflation is going down, but it's actually not. If you look at the core inflation, it actually accelerated in January. And the super core, which takes out housing too, it was the hottest figure in over a year. So inflation is not going anywhere. And interest rates are going to keep rising. And when the excess savings end, I think the US economy is going to hit the wall. And it can happen probably during the summer.
Well, then why would the market just go down until April, late April, you're thinking?
The market, because of the global liquidity, but then it can continue its march forward because the liquidity now is in the global economy is, we are not 100% sure of this, but the preliminary forecast tells us it's declining rapidly now. And when the global liquidity, the money in the global economy goes down, so does market liquidity and thus the markets. So the thing is, that is good.
Why will it stop? Why will it stop in April?
Usually it recovers in May of something, for some reason, what China does. But the thing here is now, like you meant, like good that you mentioned it, if we head into a actual downturn globally and in the US, there may be no recovery, even though the liquidity will probably stop the fall of the markets. But we are not. We are just constructing this. But the I think many of you know the yield curves now, and they are heavily manipulated. But it should be also noted that they are very negative, very much inverted now. And if you look at the timing and how it relates to history, it sets the time of the onset of the US recession to July this year to January next year. So that's kind of the ballpark figure. But we are expecting it will come during the summer, early for the latest. And there's of course all kind of uncertainties abound.
And it's only going to be a 6-month recession into the end of the year?
No, it's going to be a long one, you know, because there's also one other figure shortly, but it's just because households are so heavily in debt that not as heavily as they were in 2006, but the corporations are even more indebted. Yeah. Governments are indebted. The central banks are a mess, like you meant. Like no one knows what will happen to the ECB. Basically, I think Eurozone governments needs to recapitalize it, and that's going to create all kinds of political issues. And what about the Fed? It's also raking up a massive loss heading into the Treasury. And the thing is that it will become a political issue at some point if the Fed, there is a recession and the Fed plans to restart the quantitative easing. I'm thinking that Republicans at least will say something about that. That are you now gonna increase the future losses? So central banks have been acting since 2009 in a way they're what was never supposed to act. So they're doing stuff they shouldn't. And that's.
Let me ask you this, Thomas. That I brought this up that in bull markets, anything that could go wrong doesn't. In bear markets, anything that could go wrong does. And the debt ceiling issue is going to become real critical in June, where we Treasury runs out of unusual means to keep things going. And 100% of the people are saying, well, it'll be a lot of political theater, but just like always, they'll raise the debt ceiling. Could the U.S. be setting itself up in this environment for a self-inflicted wound? And it could be used as an excuse for everything else politically?
Well, it could. But I think more has to happen before that really occurs. But it's just.
You think they're going to raise the debt ceiling then?
Yeah.
Okay. See, we're still at 100%.
Yeah, we are.
I'm the only one. I'm the only one. And it might be a mistake because maybe someone couldn't get to Congress, they got snowed in or something. Yeah. Anyway, so all right. So, because a lot of people are talking credit events starting in June, July, and
I think they are going to start earlier.
Okay,
but we'll see.
Where do you think they'll start? Where do you think?
April.
Okay, and what do you think? Give me a guess on where you think the source is going to be. Is it going to be something like BlackRock, where they wouldn't redeem?
I don't know. Honestly, I haven't analyzed that, so I will pass of saying.
Okay.
But we just think about the timing. But coming back to the U.S. economy, there's two other things I want to talk about. The first, of course, is the consumer sentiment, and it's in the very recessionary levels still. which is, you know, where it fell about over a year ago. And this tells something also. And I think it's very difficult if you think about the, you know, the increasing of the tightening lending standards, the interest rate, all that. It's very difficult for the consumer sentiment to rise here much. It probably will rise a little, but I think this is a done deal. The recession is baked in. It's already there. The US cannot avoid it. I cannot understand why people are talking that there will be no landing, because every single thing, if you look under the hood of the US economy, tells us the recession is just postponed, but it's coming. And that's like, yeah. So I think that's strange, but there's more actually. Oops, where did I go now?
All right.
I'm going to stop sharing for a second, then I'm going to take another. Yeah.
Okay, I wanted to ask you who's selling gold?
I don't know.
And,
but it usually the thing is that usually gold, when we look at the historical crisis or periods of recession or whatever, or bigger problems, gold usually entering into the crisis, the gold usually sells, and then the buying starts about a year after. But there's one more thing, and this is crucial. This is just past week we talked with this on a banking expert who has done, you know, handled banking crisis in the IMF and back in the days and all that, and we were wondering what is going on here. So there is two series now. So there's the first one, the red one is a regulatory tier 1 capital as a percent share of risk-weighted assets, while the blue one is the regulatory tier 1 capital as a percent of assets. So if you look at the blue one first, there is this quite a big drop here, which is most likely related to the massive quantitative easing the Fed launched in during the COVID. Yeah, it pushed a lot of assets into the balance sheet of banks, while the tier 1 capital didn't raise. So okay, that's a good explanation. But the red line here is really strange. This massive jump here implies, from here we know that the regulatory 1 tier capital didn't increase most likely. But what happened here? This is the risk as a share of risk-weighted assets. So something happened to the risk weights probably, and they are now, this is still, this is to the second quarter. Now it's falling like a cliff.
Yeah.
I don't know, third quarter. And this is like, I talked with the banking expert, how he sees it. And he said, he doesn't really know how to explain this, but this is worrying. This is now below the late 2019 level. So for some reason, the risk weight on the balance sheet of bank is increasing rapidly, and this is third quarter. So what has happened till this point, we don't know. But the point is here that if you think of the banks are not tightening lending standards, and when the excess savings run out, households will start to default on their mortgages and loans. Banks will tighten further, corporations will go under, and they will tighten even further. So this will be a cycle. And if there is a crash or something in the asset markets, or something happened to the treasuries, God forbid, if there would be a default, the tier 1 capital would collapse, and it would mean an outright banking crisis in the US. And just in the commercial banks, we haven't touched the shadow banks, but I worry about those too. But the thing is, this figure tells that something is wrong in the commercial banking sector of the US while we head into a recession. This is not a good thing, not at all.
Okay.
Scared yet?
All right. So we have a weakening on all fronts.
Yeah. And it's happening
going into a recession.
Going into a recession. And this is
no cushion.
No cushion. Yeah, the thing is that there is very little cushions, and this is happening like below the surface. People do not see these things, but when you look at this, you start to get rather worried. So it's happening, but it's happening kind of under the surface. And this is, I think I saw this before. The U.S. corporate debt as a share of GDP, it's in all-time high still. So the things are not good in the US economy. And I really don't understand some of my colleagues who argue for no landing. It's absolute nonsense. At least if you look at the data, there is
What
not
are you telling your clients to do besides get ready for difficult times? Is it still farmland and gold?
Yeah, we still go with that. And now we have the global liquidity database so we're basically not telling them directly, but there is basically we're telling the same thing that I told you, that we would be short here.
Short, okay.
Yeah. And then
right.
I think if I would give
to take out the October lows, Thomas, you think?
Yeah, probably. So I would if I would be in the markets now, which I'm not, I would probably keep short now for a while and then look at things after a month in April. If there's full chaos, continue on the short and that. But it's our view that we are going to go down most of March, and it can escalate to a rout at the latter part of this month.
All right, and that's into the vernal equinox.
Yeah,
and the Fed
and the Fed and the liquidity, global liquidity, is just draining from the system.
Well, you filled up my cup of things that right in my face, and I mean we're looking at the markets and we're seeing that happen. What do you think happens to the dollar? Are they going to buy the dollar on this risk off move, or are they going to sell the dollar on this?
Yeah, probably. But another thing our analyst found already, we haven't he hasn't sent the data me yet, but he was telling me just this morning that China is dumping US treasuries, has been dumping
for a decade.
Yeah, but now it has accelerated.
Okay.
It seems. So I don't know. Usually the dollar is the safe haven, so it could be, it probably be this time around. But the one thing I want to mention about inflation, I'm doing an analysis. I publish it tomorrow in my newsletter, which you can find just Tuomas Malinen newsletter, and that's it. But there is something like hiding into the money, let's say the money supply of the United States. The first time I started to think that there's actual possibility that in a recession, if there's strong moves from the Federal Reserve, we could see a breakaway inflation. I don't give it a high probability, but the first time, I think all the history we know from the US and the monetary system, it's possible now, because of the actions taken by the Fed during the COVID spring. So it's rather interesting. I have to go through it one more time, so I don't want to talk about it too much. But the deflation scenario is not really likely at this moment. I would talk more about stagflation.
You could have deflation in asset prices and inflation everywhere else.
Yes,
is that what you're looking for? Okay,
that's possible. That's very likely, I would say.
Okay, so I'm going to go out and buy a ton of bananas today.
Yeah. That's always a good thing.
So get your food, and Thomas, best way for people to follow you and to get your reports and keep in touch with everything you're seeing every month.
You can find every link from my Twitter account. So just Google Tuomas Malinen Twitter. You can find everything there.
Okay, at MT Malinen is
my handle.
Thomas's Twitter handle, and Thomas really does look at these things. He's been talking about this, and there's been some pretty negative action in the banking index last week, led by Goldman Sachs. Which is best of breed, right?
Yeah.
So be careful. Do you think there's gonna be bail-ins, Thomas? Should I drain my checking account?
I think bail-ins are coming. That's almost a certainty in Europe, and could be even in the US. So be careful.
When by this summer?
I don't know. It's difficult to actual timing of crisis is extremely difficult, but I would say within a year.
All right.
But it can start much sooner. There was in Twitter, I think about a month ago, there was people posting videos of I think it was Bank of America. People were queuing, and they were complaining that there were money missing from their accounts.
Oh, I saw that.
Yeah, and I was thinking, is this the beginning? And the thing is that there is this one thing I could mention. There is this system put in place after the GFC, the global financial crisis, which I call the global financial lockdown. Jim Rickards speaks about that too.
Oh yeah.
So that's actual, the laws and the regulations all are in place. So all they need to do is enact it, and suddenly your funds and your deposits are frozen. And it's actual possibility because the laws and all the gimmicks are there. So you have to be careful. You have to, cash is, or even though it's inflation is running really hot, you should keep cash and physical gold. That's my advice for the very adverse scenario.
I concur.
Yeah,
I concur. So, don't keep 50 grand in your checking account.
no.
Most people say keep it to a month or two of living expenses.
Yeah, that's a good advice.
Okay, so maybe you'll thank us for talking about this someday today.
Yeah,
that we're bringing it up.
Yeah.
All right. Well, Thomas, again, great catching up with you. Really appreciate your work and you coming and sharing your wisdom and your insights with us on F.A.C.E. For
nice
years now.
For
years now. So I'll get in touch with you we'll be in touch probably in June.
Yeah,
everything should be in full bloom in June.
Yeah, they should. We'll see.
Take care of yourself. Go ahead.
Yeah, June would be good to check where we are. Yeah.
All right. So take care of yourself, your family, Thomas, and
you too.
We'll talk down the road. And again, thank you for edifying F.A.C.E.
Thank you.
Yep. All right, Thomas Malinen, everyone, follow him at MT Malinen, MALINEN. And that's a wrap. You could join the team in 14 minutes on the Morning Edge. Good hunting to everyone, and don't just count your pips, count your blessings. Adios. See you, Laura Sinatra.